Everyone, and thank you for joining our special live event today. This keynote speaker is also part of Itaú BBA's first virtual tech summit. It's going to be the first of a series of events that we intend to do in the coming months. To start off, we wanted to have a remarkable speaker, and I have the honor of having here today Chris Yeh. For those of you who don't know, apart from all of the stuff that he has done in the tech landscape, Chris is the co-creator of the term Blitzscaling together with Reid Hoffman, which is the founder of LinkedIn, and they both wrote a book on the framework. Today, we're going to have the opportunity to listen firsthand from the author about this framework, and given the level of uncertainty that we are today in the world, it's going to be really interesting to hear all of his insights. Joining with me and helping me to moderate, we have Cristiano Oliveira. Cristiano Oliveira is the CEO and co-founder of Valiosos, an artificial intelligence-based fintech. He's also based out of Palo Alto, and was actually the person who told me to call Chris to speak with us today. So thank you both for being here. So without further ado, just some notes. We are being transmitted live to LinkedIn of Itaú BBA and also Kubo YouTube. If you have any questions, feel free to write, send over to us, and Chris is going to do a short presentation just to set the stage and the background, and then we're going to do a nice conversation. So without further ado, Chris, you have the floor. Thank you very much for coming today.
Thank you so much, Julia, and thank you so much, Cristiano. It's such a pleasure to be here. So what I'm going to do in the next 20 minutes is give you a quick overview of Blitzscaling for those who might not have read the book before, and then that will flow very nicely into our discussion of the topics that's going to happen from here. And again, I encourage people to ask questions throughout. We'll answer them at the end, but I really want to get to as many questions as possible. It's really designed to be a dialogue. So let's talk about Blitzscaling. And in terms of the people who are on the call right now, I think most of you would agree that it would be very interesting for you to have a company grow 50x in terms of employees, 94x in terms of customers, and 322x in terms of revenues over the next 36 months. I think, Cristiano, that's something that you would love to see happen with Olivia, I assume.
We are almost there.
Almost there. Almost there. But these are not fake numbers. These are real numbers that reflect the actual progress of Amazon from 1996 to 1999. As you can see, this period of growth transformed Amazon from a small online bookstore into the very first e-commerce giant, a global leader with going from 5 million in revenues to 1.6 billion in revenues. And it's this kind of growth that can propel a company to market leadership that then becomes enduring market leadership. In the case of Amazon, it became the market leader in e-commerce in 1999. And if anything, today it is even more dominant than it was then. And so having the ability to build that kind of enduring market leadership can make your company enormously profitable and successful. Now, the question is, how do you do this? And of course, the answer is blitzscaling. As an author, I've discovered that the most important thing is to make up a new word that nobody has trademarked before, because then you make more money. And when you set up a Google alert on the name of your book, you actually find out about it. Our last book was called The Alliance. Turns out that's terrible for Google alerts. You can't tell whether they're talking about your book or not. But if you have blitzscaling, which is a new word, guess what? Everything is about our new word. Now, the way that we define blitzscaling is the pursuit of rapid growth by prioritizing speed over efficiency in the face of uncertainty. Pursuing rapid growth, pretty uncontroversial. Many people want to grow. Every startup wants to grow. I've never had an audience where I talked to the audience and they said, you know what, Chris, we really want to learn how we can have our company stagnate until it dies. That's our goal. It's never been a goal of any entrepreneur in history. But prioritizing speed over efficiency in the face of uncertainty, that is a little trickier because that certainly sounds risky. That certainly sounds uncomfortable. And the question is, why would someone do this? So for the answer, we're going to do a quick history lesson. In 2002, that was pretty much one of the worst times in history to be a technology company. The markets had cratered, and as a result, the NASDAQ was actually hovering around 1,000, which is much, much lower. It had declined 80%. This year, we were concerned about our markets declining 35, 40%. The market declined 80% during that time period. And Google at the time was a very small privately held company that had raised a total of $25 million. And America Online was the largest, most important company on the internet. And it had in fact bought Time Warner to form the world's largest media company. Now, during 2002, Google and AOL did a very specific deal. Google had just launched its AdWords product, which allowed it to put those little ads next to its search results and sell them to the highest bidder. And what they did with America Online is they agreed to power America Online's search engine. So America Online users would search for something. They would get Google results. Google would then sell ads against those results. And the way that money was split up was Google would give AOL 85% of the revenues that were generated. And they also guaranteed AOL $150 million a year in payments. Now, for perspective, the previous year, 2001, Google had total revenues of $19 million. And at the time, they'd spent a lot of the money that they had raised, so they were at $15 million in the bank. And they had just committed nearly $500 million on a multi-year deal to pay the world's largest company. So for those of you who have boards of directors, I want you to picture going to your board of directors and saying, we've got this wonderful deal where we're committing to pay $150 million a year. Seems risky, seems very uncomfortable. Yet at the same time, we know that this deal worked out. We're not talking about how America Online is one of the world's most valuable companies and Google is bankrupt. So what actually happened? Well, in the year following this deal, powered by AOL's traffic, Google had increased its revenues to $350 million. So from $19 million beforehand to $350 million afterwards. And remember, that's based on that little 15% share, which means that they never even came close to having to make that $150 million minimum payment because the amount of money they were generating was so huge, AOL was receiving many multiples of that from Google as a result of this deal. And the reason why it was so important for Google to do this deal is because there were very few ways to get that kind of search traffic otherwise. The dominant player at the time was Yahoo, and then Microsoft had its own search engine, and there was also Lycos. But those people were not going to do a deal with Google at this point. They had their own ideas about what they wanted to do. The AOL deal was a unique opportunity that allowed Google to catapult itself ahead of its competitors to a dominant market share. And once they had that dominant market share, they had the right market dynamics to make that enduring. So first of all, Google's algorithms aren't just good for search, they're good for figuring out which ads are relevant to which users. And so Google would show the most relevant ads, allowing them to make the most money off of the ads they displayed. So previous versions of these products, like with Yahoo, they would display the ad from the highest bidder. But maybe the highest bidder is a moron. Maybe they make bad advertisements, or maybe they're not actually targeting the right customers. Google's algorithms would figure out which were the right ads to show that would both generate the most money for Google and AOL, as well as be the most relevant to the consumers. And as those algorithms cycled through more and more data from that volume from AOL, they got stronger and stronger. And it meant that Google could monetize search traffic better than any of their competitors. And the longer they went along, the bigger that advantage got. The second is that AdWords and Google's AdSense, which is the offshoot that allows other publishers to run Google ads, are two-sided marketplaces. They're marketplaces that bring together sources of traffic like publishers and the people wanting to purchase the traffic or the advertisers. In a two-sided marketplace, people are going to gravitate towards the greatest liquidity. Advertisers want to go where the users are. Publishers want to go where there are advertisers who are willing to pay. And so as a result of those two-sided marketplace dynamics, Google has become one of the leading players in online advertising. In fact, Google and Facebook dominate the online advertising market and account for, I think, over 70% of that market. And they are growing while the rest of the universe of firms is shrinking. There are others that are still growing, some. There are companies that are successful like Snap and Pinterest. But overall, the online advertising market outside of Google and Facebook is shrinking. And that's because the market dynamics allowed Google to blitzscale its way to a market leadership and then retain that market leadership for almost 2 decades. And that's the reason why you blitzscale. Now, the question you might ask yourself is, should everyone blitzscale? Well, many of you have probably heard about the company known as WeWork, which famously had attempted to go public at a valuation of $47 billion or more. and more recently conducted a round of financing at $3 billion. So what happened with WeWork? Why was it that WeWork wasn't a successful blitzscaler? Because they absolutely were pursuing rapid growth. They were absolutely prioritizing speed over efficiency. And the answer is, was this market actually blitzscalable? Right? If we look at it, the characteristics of this market were not like Google, where increasing your volume made you wildly profitable. Instead, what we see is the faster this company grew, the more it lost money. And there was no sign that it was going to reverse that. So what are the actual characteristics that reflect a blitzscalable company? Well, what we've done in the book is we've outlined these key factors that tell you when you should blitzscale. Now, the metaphor I like to use is this is a race. Some of you who are sports fans may recognize the great sprinter Usain Bolt, utterly dominant at the Olympics and on the world stage. So dominant that he literally ran away from the field and could stop and look back and see how much he was winning by and just enjoy himself as he crossed the finish line. That's what blitzscaling is about. It's about getting far enough in front of the pack of competitors such that you have the ability to build that enduring market leadership. So what are the things that mean you should emulate Usain Bolt? Well, the first is having a big market. This is really important because you want to build a multi-billion-dollar company, and to do that, you need a big market. But the nuance here is it should not be the present market. It's all about the future market. The present market is the reports you find on Forrester and Gartner. The future market is what you can figure out by looking at the trends in the world and understanding how technology is fundamentally changing it. A number of years ago, when ride-hailing was just getting started, there was a professor at NYU, very famous professor named Aswath Damodaran, who is known on Wall Street as the dean of valuation. In other words, the person who is the world's leading expert on how to value companies. And he conducted an analysis that said that ride-hailing, and specifically Uber, could never be worth more than $1 billion. And his reasoning was very simple. There's a $100 billion global taxi market. Uber might capture 10% of that to get $10 billion in gross merchandise value. You apply a take rate to that. You apply gross margin to that. You apply discounted cash flow to that. And the answer is roughly $1 billion. Now, the mistake in that is not in the math. The math is all 100% correct. The mistake is in saying that the market for mobility, or Uber, is 10% of the global taxi market. In fact, Uber's billings have long since exceeded the entire previous size of the global taxi market. And the entire ride-hailing industry is many times the size of the previous global taxi market, because as the product becomes easier to use, becomes less expensive, becomes a competitor to actually owning a car, the market expands dramatically. And so it's all about figuring out where the market is going to be in 3, 5, and 10 years, and really building your company around that. The second is massive frictionless distribution. If the goal is to achieve market leadership, then you want to be running along a smooth track, not bumpy, gravel, uneven ground, so on and so forth. You want to figure out how you're going to be able to get distribution, to get your product and services into the hands of as many people as possible. In the world of blitzscaling, that typically means one of two things. It could mean there's virality built into your product, and so that as you gain users, it encourages other users to join. Or it could mean that you're able to tap existing distribution networks. So for example, you might be able to tap into the colleges, which is what Facebook did. It built itself up as a social network on individual college campuses, leveraging the existing network of college students. Or in the B2B world, you might be able to leverage another company's distribution. Microsoft blitzscaled Microsoft DOS into the leading operating system by riding on top of IBM's distribution network. So there are ways to achieve massive distribution. Third are gross margins. And this is an area where WeWork really fell down. WeWork actually lost immense amounts of money for every dollar of revenue they brought in. The reason you want high gross margins is because they allow you to finance the growth, which is so difficult to finance, and because those high gross margins make your company more valuable to investors in the long run. It increases the size of the reward for blitzscaling. So you want to seek those high gross margins, typically 60% or higher. Ideally, you end up with software gross margins, which can be 80 or 90%. Network effects are probably the single most important factor. Network effects are what makes this a winner-take-most market, where whoever becomes the market leader builds enduring market leadership. Remember the story of Google, but perhaps even more, remember the story of eBay. eBay is a company which built itself into an e-commerce giant on the back of its two-sided marketplace of buyers and sellers. And eBay has been so successful with building that network effect is that even today, their product, which is literally not changed in 20, 25 years, like their only change that I really remember making a difference was adding buy it now. Their product has not changed in 2 decades, and they are still a dominant player in their field. That's the power of network effects. That's the power of winning a winner-take-most market. You can take 2 decades off and still keep printing money. So look for those network effects. One alternative, I usually talk about network effects, but one alternative is also what we call a land grab. If you have the ability to lock in relationships on a more or less permanent basis, that is also the basis for blitzscaling. And the key is oftentimes people like WeWork said, this is a land grab. We literally are signing leases on office buildings in cities around the world. The problem with that is the land grab is not exclusive. If you look at a WeWork office in Sao Paulo, for example, you can see this building, great fancy offices, and then to the left of it, you can see another building, and to the right of it, you can see another building. And the point is, even if you grab that land, there's no exclusivity. There's nothing that prevents other competitors from coming into the marketplace. Now, if you grabbed all the office space in the city, that would be a different story, but that would also be financially impossible for a business model like WeWork's. Finally, product market fit is the thing that you need to sustain yourself. So some of you may be familiar with a company called Groupon, which grew faster than any company in history in terms of revenues, but it's no longer an important company. Why? Because its product was not good for its consumers or for the merchants. Nobody kept using it. All of us have probably used Groupon at some point. None of us used it in the past 30 days because the product sucked. And so the reason product market fit is so important is because it's necessary to sustain you over time. So should I blitzscale? Well, take the example of Mercado Libre. So Mercado Libre is a company that is like eBay, a marketplace business. And so it has those characteristics that allow it to blitzscale. But what's interesting about Mercado Libre is that in addition to the marketplace dynamics that eBay had, it also was able to bring online things like Mercado Pago in order to make it possible to actually carry out all the transactions. In an emerging market where the infrastructure is not as far along, being able to build out your own set of complementary services becomes an even greater competitive moat. And that's why we see Mercado Libre growing faster today than its US equivalent eBay, because of the fact that its control of the infrastructure that it uses to operate is greater than that for eBay, and that creates an even greater competitive moat. So in terms of blitzscaling, you can think of it as a company that is growing from a family ultimately up to a nation. And as an entrepreneur, the key to remember is each of these phases is very different. A family is run very differently than a tribe and is run very differently from a nation. So instead of thinking about it as I'm going to make my company succeed, think about it as I'm going to make each stage of my company successful. And each stage, I'm going to have to continue to learn and continue to develop new techniques. The key transitions of blitzscaling reflect that. You're going to be able to go from small teams to large teams, from generalists to specialists. I won't talk about these now because they're all laid out in the book and because we have a short period of time, but recognize that you're going to have to navigate these transitions. The next thing is that there are counterintuitive rules of blitzscaling. Because you're prioritizing speed over efficiency, you're doing something against all the things you learned in business school, you're going to have to follow a different set of results. And I don't have time to go over all of these either. Again, they're all laid out in the book. But I will mention one of them that I think is very important to note, which is do things that don't scale. So one of the things that is very tempting to do is to focus on doing things that scale, building things right the first time. But the fact is, as you saw from that chart of the different stages of blitzscaling, it's almost like a different company at every stage. And so it is better to do things that don't scale, that get you to the next stage, because you're going to have to refactor and re-architect anyways. Now, there are some cases when you can really trip yourself up. Friendster is a social network that many people may be familiar with. Friendster actually failed in its attempt to become a dominant player like Facebook because it could not scale its technology infrastructure. So there are limitations to doing things that don't scale. Do things that don't scale but work. Don't do things that don't scale but don't work, right? Your product has to work. But it is a key technique to keep in mind. It's something that is counterintuitive for many. Now, let's talk briefly about the impact of the coronavirus on blitzscaling. So what it has caused me to do is to change the definition of blitzscaling slightly, because growth is difficult to pursue in an environment like this where people are locked down and where there is a lot of economic dislocation. Instead, blitzscaling is the pursuit of rapid change by prioritizing speed over efficiency in the face of uncertainty. In this market, the premium is on being able to adapt to the new conditions. And that means adapting quickly. Even if it is less efficient to do something in a certain way, if it allows you to change direction faster, it may be worth it because of how quickly things are changing. If you go about things the same old way, emphasizing efficiency, you may never catch up with events. The analogy I use is you're sailing against the wind. There's a storm going on, gusts of wind are blowing from every direction, and they're changing directions all the time. And your boat has to be able to very quickly change its sail, very quickly change its course to be able to capture that wind. And the path to dominance may not be a straight line as before. It may be zigzagging back and forth. And so your ability to be agile and adaptable during that time is going to be the key. So again, we've just managed to bring it in just that 20-minute mark. Thank you for taking the time. You can find me in a variety of different ways. Because you are friends of Itaú BBA, you can certainly connect with me on LinkedIn and follow me in these other ways. And I will just go and quick recap. Blitzscaling is about prioritizing rapid change by prioritizing speed over efficiency in the face of uncertainty. We're all dealing with a lot of uncertainty right now. The core to blitzscaling is to find a winner-take-most market and achieve lasting dominance. You could print money for decades. It's very difficult to do. It's very counterintuitive. But if you manage the key transitions and follow the counterintuitive rules, the rewards can be great. And with that, I'll turn it back over to Cristiano and Julia.
Thank you, Chris.
Thank you, Chris. Fascinating presentation. I have a lot of questions. I could spend the whole day asking you questions. We are big fans of your work and book at Olivia. We are always debating about blitzscaling. But let me ask you a first question. In fact, I have two questions that I believe will help us to kick off the discussion. The number one is, the first question is, I remember in 2009 or 10, I went to the first Lean Startup conference in San Francisco. There was kind of 10 people that paid to go there. And I remember Dropbox talking about Lean Startup and everything. In the last decade, I believe with all the liquidity we have in the market, VCs willing to give us money, people start wondering, should we, is blitzscaling a different philosophy than Lean Startup? They are complementary. Should I use them in different moments in my lifetime at this startup? So how you see Lean Startup and blitzscaling as philosophies for startups?
So Reed and I view the Lean Startup as highly complementary to blitzscaling. What you're doing is you're applying these different techniques at different times. So with the Lean Startup, which of course is the work of Eric Ries and Steve Blank, who are friends of ours, and we tremendously respect their work. The Lean Startup is all about finding that product market fit. Mm-hmm. And in an environment where you are doing something very new and you don't necessarily have competition yet, it's a good idea to follow that Lean Startup process to learn as rapidly as possible, but to not really start spending huge amounts of money until you believe that you've achieved that product market fit. And we described how product market fit is so important to blitzscaling over the long term. Now, where we diverge from the Lean Startup is in those cases where you haven't been able to achieve product market fit yet, but you find yourself in an immensely competitive landscape. And the reason is, in that environment, yes, it is ideal for people to wait until they achieve product market fit to scale. But if somebody else scales first and achieves product market fit thereafter, but has that market share lead and has already won the market, then you're shut out. And so in those circumstances, you may need to blitzscale while doing product and customer development at the same time. And that is riskier. But in an environment where somebody else is building a lead, you can't necessarily count on the fact that they will stumble and fail to build product market fit. It has happened before. Obviously, in the case of Facebook, for example, MySpace was the dominant social networking player before Facebook came along. MySpace stumbled because its emphasis was not on the person-to-person network, but rather on sort of basically being a fancier web page for bands and other brands. And that just didn't have the same winner-take-all characteristics that Facebook had. But had MySpace been smarter about it, it is possible that Facebook would not have succeeded.
No, that's a great way to see it. And we should always remember that Lean Startup was created around 2008. There was no money. And I think it has changed a lot in the last few years. I just have one more question before Julie can ask hers, and also questions from the audience today. If we see the most successful startups or tech companies, usually the way I see is I'll call first generation on the internet. So Google, Amazon, even Facebook, they were able to figure out the economics very early. Amazon was able to make a decision to say that is, hey, your profit is my competitive advantage, but they figure out the unit economics very early. And in the last decades, people kind of forgot about unit economics. Maybe WeWork is the worst example, but even Uber, maybe these days they are losing less money because less rides. So how do you see this? It's fair to say that there was more concern about unit economics less recently, and how you see going forward this balance between scaling, growing unit economics, and everything. I know that you mentioned high margins, so that's also interesting points for you to explore a little further.
Absolutely. So this is a very important point, and I'm going to split it into two answers because I think there's two very important lessons from this. The first is that we absolutely believe in unit economics and ultimately high gross margins. And the thing is, what people don't realize and what's nuanced is that it may be that you don't have the right unit economics today, right? The unit economics you have at a certain scale or a certain number of people is not the same as what you'll ultimately have. The example we use is LinkedIn. So my co-author, Reid Hoffman, is of course the co-founder of LinkedIn. And one of the things he knew when he started LinkedIn is that until LinkedIn had 1 million users, it was essentially useless. And so he had to figure out how to bootstrap the company to 1 million users before its network started to really take off. The second thing is he said, do I believe that there is ultimately a high margin business available here? And his assertion was, if we become the default professional identity for workers and professionals around the world, that is ultimately enormously valuable. And he had some hypotheses around what the company would eventually do to make money. They're like, well, it could be advertising. It could be subscriptions. It could be enterprise software. There's a variety of different things we can do. And he didn't necessarily say this is the model that we're going to have. He just saw that there were enough possibilities that it was pretty clear one of them was going to work out. This is different than sort of saying, you know what, the unit economics don't work today, but they will someday. Volume, right? He had a specific set of possibilities in mind. Now, as it turns out, LinkedIn's business model ended up becoming primarily enterprise software. LinkedIn generates most of its money from licenses sold to companies that are recruiting. And the recruiter software, which is enterprise software, generates most of LinkedIn's revenues, not the subscriptions or the advertising or the job boards or any of those things. That's not something Reid knew in advance, but he knew that there would be value there. The problem with the WeWork is the idea behind a WeWork was relatively straightforward, at least to me, before I saw the numbers. What I thought WeWork was doing is they were convincing human beings to accept 50% less square meters per employee and then charging 50% more per square meter. And if you do that, then office space costs 25% less for the company, but generates 25% more money for WeWork. And so if you can generate 25% more money per 50% more money per square foot than WeWork, then you've got a great business model. All of a sudden, you could take the same office building and make 50% more money. What's not to like? The problem with WeWork is if you actually look at their figures, the amount of money they generated per square foot was exactly the same as their traditional competitors. In this case, it's a company called IWT that operates Regus. And so it's like, well, what's wrong with this picture? You have double the expenses, you have the same revenues, This just doesn't work. The whole hypothesis was you could get people to pay more, and they weren't making it work. Now, you may say, well, wouldn't they be able to get to that once they got to capacity? They were at 80% occupancy. So in order to get to break even, they needed to double their occupancy to 160%. There is no world in which that math works. Now, the Uber thing is actually an interesting and separate point. Uber is an example of the limits of network effects. And I haven't published this essay yet, but we've worked on an essay that actually looks at how Uber's network effects compare to similar on-demand business models. So you can sort of lay it out as a continuum. On one end, you have Airbnb. In the middle, you have Uber. And on the far other end, you have Lime or Bird, which are these bicycle or scooter rental companies. And basically what you do is you look at the nature of the transaction itself and how valuable is the transaction and what level of consideration goes into the transaction and how differentiated is the transaction. In the case of Airbnb, the business is obviously hurting right now because of the fact that there is a global pandemic on and travel is dramatically affected. But I expect the company's business to rebound once medical science has been able to get us past this terrible pandemic. And the reason is that it has a high value transaction, hundreds of US dollars. It is a high consideration transaction. I ask people, when you go on Airbnb to book a place, do you just pick whichever one is lowest price? You don't look at the photos, you don't look at the neighborhood? No, you carefully consider all of the options before making a choice. And then finally, how differentiated is it? Is every apartment the same, or does choosing the right apartment make a big difference? Absolutely does. So that's a case of a highly differentiated, high value, high consideration marketplace where the marketplace adds a lot of value and where there's an enormous network effect because you're going to go to the place as a consumer where there are the most choices of rooms. And you're going to go to the place as the marketplace as a host or a hotelier where there are the most consumers who are interested in renting rooms. So they have a very strong network effect that will likely keep them as the market leader for decades to come. On the other end of it, you have something like a Bird or a Lime, a scooter or a bike rental. So it's $2 or so to rent one of these things. Every single one of them is completely identical. And the amount of time you spend thinking about whether you're going to pick this one or that one is limited to which one is closer to me. And Uber actually sits in the middle. So Uber sits in the middle because they have the driver network, right? So it takes time and energy to build up a driver network. With Bird or Lime, you just buy some bicycles and throw them on the street. With Uber, you actually have to recruit human beings. And that has meant that ride hailing tends to be an oligopoly. So you'll have one or two, you'll have maybe two, maybe three, but generally two major players in every market because it is possible to get to a certain scale and compete because you just have to get enough drivers in. Now, the transaction is in between Airbnb and Bird. So instead of several $100s, instead of single digit dollars, it's double digits, $20, $30, $40. And there is some slight level of differentiation because you can see what kind of car it is. You can see the driver ratings. But what I tell people is, how often do you summon an Uber and then you look at the driver and you say, not that one? When's the last time you did that? Doesn't happen very much.
Never.
Yeah. So that tells you why there's a limitation. So Uber's network effects are strong enough to give it an oligopoly position, but not strong enough to give it that dominant, enduring market leader position, which then enables you to charge enough money to make money. The oligopoly, where you have Uber and Lyft in the United States and Uber and various other players overseas, it could be Gojek, could be Didi, it could be whatever. In the case of Didi in China, Uber actually became Didi. But the point is, you can never get to the point where you're actually able to charge a premium and make money. And so it's enough to be valuable as to be the value that it is, but it is not the same as a marketplace like an Airbnb, where you do have a set of market dynamics that drive towards a single player.
Now, fascinating. Julia, your turn.
Yes, I have a question. Before I ask my question, Chris, can I ask you to stop sharing your screen?
Oh, yes,
so we can see each other.
Sorry about that.
No problem at all.
Let me get that up and running. And where is that control? There we go. Stop share. Perfect. Sorry about that.
Perfect.
I completely forgot.
No problem. No problem. So my question is, after you guys published the book and the term came up, there was a lot of discussion related to what is a sustainable growth and a growth that you could pursue versus a reckless growth. Because we have seen, and you mentioned a lot of examples, companies that I think that they intended to blitz scale, but they went over themselves and they spent a lot of money, and the cost for not being so efficient at certain points in time actually cost the life of the company. So I wanted for you to give like a bit of a color. What is the difference between a reckless growth and a blitz scaling that is responsible?
So the key to figuring out whether or not the growth is reckless or responsible is to ask yourself, what is the mechanism by which achieving this growth is going to lock in sustainable competitive advantage? Right? Because it's all ultimately about sustainable competitive advantage. When we talk about network effects, when we talk about market dynamics, when we talk about land grabs, it just basically says that being the market leader gives you a strong competitive advantage or moat. That terminology has been around for a long time. And so for the companies that are saying, we're going to grow, we're going to have this incredible revenue, we're going to blitz scale, they do it because, guess what? It feels good to have a lot of money and to grow and to have everyone say, wow, I see your company everywhere, and every year 100% more people use it. But it doesn't help much if there's no real competitive advantage, and if in fact you're just losing money all along the way. And so in the book, we at the time WeWork was still, when we were writing the book, WeWork still wasn't as famous as it was, but the people we focused on were actually the food delivery services. Our assertion is, with the food delivery services, there's no sustainable competitive advantage. I don't know if you guys have ever used a food delivery service in the United States. There's a number of them. There's DoorDash, Uber Eats, Postmates, Grubhub, Seamless, et cetera, et cetera, et cetera. Some of them are starting to consolidate. But I've never met someone who say, you know what? I will only ever use DoorDash. I am a DoorDash household. Screw Uber Eats. Screw Postmates. I refuse. No, people are like, whatever, whichever the rest. It's about which one is my favorite restaurant use, and if so, I'll use it. And so, where's the sustainable competitive advantage? Where is the ability to say this is why nobody else will be able to compete? And now, the separate thing is in terms of responsibility as a whole. A lot of it, one of the things we talk about in the book is the principle of responsible blitzscaling. And what we tell people is, because your company is growing so quickly, and because you're sort of baking in all these things into the business model, into the culture of your company, it is even more important for blitzscalers to be responsible than traditional business growth, because it's harder to correct those problems later on. Whatever initial sins there are get magnified by that rapid growth and inflation of the company and the product space. So as a result, we encourage blitzscalers to think early on about what is the impact they're going to have on society. What are the risks that they're introducing? Sometimes it's hard to foresee these. So for example, Facebook is a company where there were risks that nobody foresaw up front, as in, oh, this will eventually cause people to become more politically divided. It'll become more difficult to convince people of the truth. That's not something I think anyone said when Facebook or Friendster came out. Oh, this might destroy the truth. But as it turns out, there are unanticipated consequences. And so not only should you anticipate these consequences, but if unanticipated consequences arise, you have to remember that it is entirely possible that your company is going to do things that are damaging to society. And if so, it's your responsibility to fix them. Because if your company destroys the systemic underpinnings of society, you're not going to be a successful company for very long.
Very interesting. Can I just do a follow-up, because I think that I don't want to lose this topic, because it's been, given the pandemic, you mentioned the food apps, right? So given the pandemic, we're talking a lot with these players. In Brazil, we have two major players with these guys, and trying to understand to what extent can they grow and what are the growth prospects. So you were really clear to say that there's no, at the end of the day, for the end consumer, there's no differentiation. So I'm asking your opinion. These apps, they intend to become super apps in Brazil. If that is a possibility, we don't know. So my question to you is this: first, Do you think that to be the winner, you have to go to the path of being a super app in order to be different? And second, do you think that the super app concept is viable, like in the US or in Brazil?
So I do think that super apps do represent a blitzscalable business opportunity. And what you can then do is you could then look at something like food delivery as, instead of a business of itself, as a powerful marketing channel, as a way of driving adoption. Because if you think about it, during this pandemic, food delivery has received an enormous boost. Since people can't go to restaurants personally, everyone has had to order more. I know that even my family has ordered more from food delivery than before. I've not, even though I don't believe in the business model, I'm not averse to using its services. I absolutely think if I want to spend some other investor's money, I don't have a problem with doing that. So what I do think is, from the super apps, if you look at the super apps, and the example that I'm most familiar with, of course, is over in China and WeChat, WeChat, which can essentially do almost anything, right? It's commerce, it's communications, it's all these things rolled into one. It's because you have certain things which have those strong network effects that basically make it ubiquitous. And then it just becomes easier and easier to do everything within the context of a single app. You see that happening with Amazon. Amazon, if you think about it, Amazon's core retail business should not necessarily be that blitzscalable. It's selling stuff online. Why is that different? And the answer is, all of us use Amazon so much for a variety of reasons. It's convenient. They have Amazon Prime. They have their marketplace, which, by the way, has two-sided marketplace dynamics that makes it winner take most, winner take all. Amazon, again, I would argue that Amazon, without Amazon Prime, without Amazon Marketplace, wouldn't be the same Amazon it is today. It was able to use a business that was not necessarily blitzscalable per se to build up an audience, a set of customers that it was able to then encircle with things that were actually winner take most markets. So I think that the super apps could absolutely work. And the way to think about this pandemic right now is, this pandemic is driving trial, right? It creates urgency to cause people to try new things. And if you have something where once people try it, they're going to keep using it, where there's enormous stickiness, that's one of the ways you can actually leverage this pandemic. Because if you're a company, driving people to try something new is really hard. But when there is law, regulation, outside dynamics that causes them to do it, that gives you your opportunity to really shine.
Chris, for my own benefits, I have a question for you related to fintech. Traditionally, financial services is not, in most countries, winner takes all. We have massive banks, but we don't have a bank that is like a Google, 80% market share, or Apple and Google, half of the mobile mobile phones in the US. So do you think fintechs are blitzscalable? And if they are, do you think there is any fintech that could be a reference in terms of blitzscaling?
Absolutely. So fintech can absolutely be blitzscalable, and it can also be not blitzscalable. It's going to depend on the nature of the market dynamics involved. A great example, of course, is if you look at PayPal, which is a $100 billion plus company. And it's no surprise that it has my co-author's fingerprints on it as well, from a strategic perspective. So the thing about a payments network is it is a classic network effect, because each time you add a new person to that payments network, their ability to take payments, their ability to send payments, makes it more valuable to every other person in the network. There's also inherent virality, because it's easier to send money via PayPal. I mean, we do this all the time with other parents. Oh, can you pick up these snacks for this party? I'll PayPal you, or I'll Venmo you the money, which of course PayPal bought because it recognized that Venmo was a competitive threat. And so if you look at that, there are absolutely blitzscalable elements to fintechs. There's also, I think, a subtle way in which fintechs can benefit from blitzscalability, which is to say, to leverage the tools of blitzscaling without explicitly adopting blitzscaling wholesale. So one of the things that I know about the financial services industry, which is where I actually got my start when I left college. I first worked in the financial services industry, well, in the tech area of the financial services industry, is that the enormous value of the individual customers drives a very different set of customer acquisition discussions than in many other industries. To acquire a user for a news website, the value of that user, of that particular quote unquote eyeball, is minuscule. The value of a financial services customer is much greater, which was why in the old days people were willing to spend, if you think about online brokerage, $1,000 to acquire a customer because they were just that valuable. And so one of the things I've often thought is really powerful from a financial services perspective is to leverage the sort of virality and distribution elements of the more consumer blitzscaling world to acquire the customers on the financial services side. One of the companies that has been fairly successful in the United States is a company called Robinhood. And Robinhood basically said, what if we took online brokerage and we treated it as a consumer application? And basically made it as easy to use as a consumer app, and also made it seem like the trades were free. Now, as you and I know from working in the financial services industry, anybody at any point in time in the past 10 to 15 years could have said our trades are free. The thing that held people back is that I just don't want to give up that free money. But Robinhood said, you know what, we're going to rethink this. And the thing that brings people in is the trades are free. But the reason they're going to stay is because we're going to apply consumer dynamics to how they use the app and make it into a gamified experience and make it a social experience and leverage the tools of blitzscaling to acquire the customers, but then monetize them with traditional fintech ways. And that's almost the best of both worlds. Because if you have a consumer grade customer acquisition at a very low cost and then financial grade monetization in a way that's based on assets, that's highly monetizable, then you've got something really good.
No, great. Thank you.
I have a next question for both of you. So in a world where, okay, now we have the big companies already consolidated. You mentioned Facebook, PayPal, Amazon, all of the companies. And in a world that we have a lot of new companies that want to blitzscale. In my view, and correct me if I'm wrong, we have a scarcity of talent. Even more so when you talk about technology. In Brazil, this is really significant. Now I think that with remote working, this is going to be a bit solved. But developers are scarce, and when they're really good, they can choose where they work, right? So my question to both of you is first, how to face and convince these guys that they should work on your company that you are now blitzscaling, and this can go to Christian, and you can talk a little bit about your culture. But even more so, how do you see, Chris, looking ahead, a world where there are all of these companies fighting for the same talent?
Great. So it sounds like Cristiano should answer first, but I'm also happy to answer first, whichever your preference is.
I believe the talent shortage is a problem when you talk about tech, and even worse when you talk about AI. That is our case. We have to compete with our self-driving car companies that are raising billions of dollars and are promising people they're going to build something that you only used to see on sci-fi movies. I believe there is a structural problem that we alone cannot change. There is a shortage of talents. But I believe, on the other hand, we talk about blitzscaling. Maybe someone should invent the word blitz hiring, because there are some companies that are very innovative. I didn't have a first-hand experience, but I have some Uber folks with us, and they mentioned that on the early days of Uber, the approach was, hey, we're going to reinvent how we hire people. I don't know exactly that way, but there was something like, hey, make an offer to all your friends. If you think it's good, hire them. So there is no interview, no HR, because you work here. If you hire bad people, you're not able to deliver. So they create a process that is a lot of top engineers get unsolicited offers, not even interview invites, to come to Uber. So I believe on a more tactical standpoint, if you rethink how you hire people, you can be more aggressive and bring people on board. I believe now is, unfortunately, it's a good time to play arbitrage. A lot of great people left great companies. So another strategy is in a downturn, if you're still building your business, it's a good time to hire talents when everyone is laying off. And there's another thing that is always true in the startup world is you need to have a vision bigger than anybody else that is believable. Because your employees are your investors. They are trading all the perks you can get at Uber and Google. Once a while, I go to Google to get free lunch because it's so good, you cannot compete with their free lunch. So we just call a friend and say, hey, can you have Olivia lunch there at Google? And we go there. So I believe there are three things. One is the going now in the reverse sequence. One is the universal truth about startups. Everybody wanna work in someone that's winning, that is growing. If you're not growing, there's no talent. So the way I see is the default company is, yeah, I go to Google, Apple, it's great, pay well, perks, it's work. And you'll be there for a long time. But then, if you are growing, you see Uber are able to hire amazing talents. If you are growing, so I'd say if you want to attract talents, number one is big vision, nice product, but growth. If you are growing, people want to join you. People don't want to join startup growing. Second one is downturn, opportunity to hire, if you are prepared for that. And number three, Blitz hiring. Maybe, Chris, we should write a book, Blitz hiring, about this unique approach to bring people to your company, like make offers and your employees vet your candidates. So my 2 cents in 3 topics. Would love to hear from Chris as well.
Well, I heartily agree with what Cristiano has said, and I can confirm that we went ahead and we checked with Uber executives, and what they did do was, in fact, ask each new engineer they hired, who are your 3 smartest friends, and then they sent them offer letters directly. So they absolutely did that. It is a fascinating thing. There are some problems with doing that, but I think ultimately was the right thing to do. And I agree with, like I said, everything you said. I'll just add a couple of additional nuances. So I think that the interesting thing to note is that this is the ability to hire people ahead of Facebook or Google basically boils down to, that sense of meaning, purpose, the ability to accelerate the person's career. And Steve Jobs exemplified this when he recruited John Scully away from PepsiCo. He simply said, do you want to spend the rest of your life selling sugar water, or do you want to change the world? In the case of hiring against Facebook or Google, what you would say is, do you want to spend the rest of your life figuring out how to get people to click on ads 0.1% more, or do you want to do something meaningful? Because it is absolutely the case that they have, especially in the case of Facebook, received this bad publicity recently, where I think you have a greater chance. People are saying, I'm not going to work for Facebook. I'm not going to work for these companies that do business with the Trump administration or what have you. So I think that there is an opportunity there. But the final thing is just to remember that in addition to hiring great people, you can actually make great people, right? And it's so hard to find someone with an AI or data science background. But if you have people on your team who are interested in learning about these things and who want to take some time, say, hey, why not set aside a couple hours during the workday, now that everyone's working from home anyways, and use that time to study some of these new technologies, educate yourself on it. And that's good for them too, right? They're going to, in addition to being able to have new capabilities for your company, make themselves more valuable in the marketplace for the long run. Because again, while hopefully they stay at Olivia forever, again, maybe the company doesn't succeed, or maybe they want to start their own company, and having those skills will help them someday.
Yeah, very interesting.
I believe, Chris, I completely agree with you as well. And these days that we need to find great talent, let's remember that we also have a competition with big companies, traditional incumbents. So maybe we cannot get people from all the people we want from Google and Facebook, but we can get very top talent from established companies that cannot offer what a startup can offer. So for you to make new things, impactful things in an established company. So for example, at Olivia, we balance a few things that are higher top talents. I would say consolidate talent that did before multiple times complex stuff from these big tech companies, but also we hire people that have a lot of potential, no skills on that specific subject, and pair with that senior people. And also we go to industries that are not as appreciated as maybe tech today, and get a great talent. So I believe there's a lot of opportunities, but definitely we don't have talent to everyone. So that's, I would say, more a nationwide challenge that as tech move. If you see even the current layoffs, that are very sad thing that happen in some big tech companies, most of people are not tech. Most are operations. And most people are not from Silicon Valley, that is more expensive. They are from satellite offices. So there is a core that even the downturn, companies don't want to give up because they're highly valuable. So building your own is something that can be very interesting. So
I have a quick question now for Chris. Chris, how do you take Blitzscaling to private investments? Now we talked before, right? So you have you're starting your fund, right, on Blitzscaling. How can you take all of the framework and put it in private investments, and what company to invest?
So with Blitzscaling Ventures, that is a venture fund which I've started that applies the principles of blitzscaling to investing. And what we do there is we survey the universe of startups, especially those startups which have done deals with top venture capital investors. And we assess the blitz scalability of those companies. We actually look at those growth factors that I laid out earlier in the presentation. And we use a special formula with a certain exponential functions because some are more important than others. So for example, obviously the network effect and the distribution are the two most important factors because they tell you whether or not it's possible to have a winner take most market and whether or not you have a clear path to achieving that market leadership. And then based on that, we're able to pick out from that list of companies that are already, top companies because they're being financed by great investors, and get investments into the ones which have the greatest potential to be a $10 billion plus outcome. So that's how Blitzscaling Ventures works. And one of the things that we do as part of this is actually we're going to be building an online community for investors who want to learn about this approach. And they'll be able to actually join our Global Scaling Academy and look at Blitzscaling for investors and take a course and have regular meetings. And one of the things you and I have discussed, Julia, is potentially inviting some of the folks that maybe some of the folks who are on this particular broadcast right now, to a special fireside chat with myself and my co-author, Reid Hoffman, who is an investor and advisor to Blitzscaling Ventures, about how you apply these ideas. So a lot of great stuff coming up, and rest assured, I think, certainly you can sign up for my newsletter and I'll try to reach out to people, and hopefully the good people at Itaú will also reach out to you as these opportunities arise. For sure.
I guess we're getting at the end of the webinar. Just Cristiano, do you have any final words? Chris, do you have any final words to wrap up?
Just wanna thanks, Chris, for sharing this information and knowledge today. Was pretty insightful. And I believe everyone that is attending to this broadcast should be thinking about if your business is Blitz scalable. And I believe that's an important message from Chris, that is, not necessarily everything is, but if it is, well, I read a book, highly recommend, and I believe it's create a new mindset. Because, as I mentioned, that is the traditional mindsets, I would say more Wall Street financial statements. Let's see how much this company is worth. That is the lean startups, not the only one, but experimentation. But there was a void in the market about, okay, I have product market fit. How I take over the markets? And if you talk about Brazil, Brazil is a country that, in a lot of industries, winner takes all. If not the winner, few winners. If you see the major segments in Brazil, there are few companies that have a substantial market share. So I believe everybody be intrigued in see if it's applicable to them, and if it is, it's a very interesting journey to follow. And once achieved, it's, I believe, change everything. Thanks so much again, Chris.
Well, first, I want to assure everyone, first, thank you, Cristiano. Second, I did not bribe him before this webinar to say all those wonderful things, but I really appreciate it and I'm so grateful. I'll leave on a broader thought, which is just, we are gripped by this terrible pandemic, but I have confidence in human ingenuity. I have confidence that scientists and doctors will find a way to eventually beat this disease back. But when that happens, we're going to have to dig out of an economic calamity. And entrepreneurship and the ability to restructure the world and create new things is going to be more important than ever before when that time comes. So those of you who are entrepreneurs, you're doing very important work, and I want to encourage you to continue doing that work and to help reshape the world as it recovers.
Perfect. Thank you very much, Chris. Thank you, Cristiano. Thank you all for watching today. And that's it. Good afternoon.
Thank you so much, Julia. It's a pleasure to come on.